Hello, everybody, and welcome into today's amazing live stream. We have some incredible guests joining this show. Obviously, I'm co-hosting here with Evan from Stock Market News, but so excited to have Bilal Little, the director of ETFs at the New York Stock Exchange, as well as Tony Dong, a legend in the ETF world and the lead ETF analyst for ETF Central, which he'll be representing today on the live stream. This is going to be a good one. We're going to dig into this ever-changing landscape of ETFs and what it has turned into, walk through some of the data behind all this, the segmentation items on ETF Central, and then, of course, just talk about this market in general. Very excited to do this. Bilal, welcome to the stream. Thanks for coming on.
Thanks for having me. Excited to be here.
Absolutely. Tony, really excited to have you on this.
Always happy to collaborate with your team.
Beautiful. Well, let's get right into things. Evan, I'm going to bring you into it off the start. We talk ETFs all day, and you are putting out tons of information on, your main account, other ETF accounts. What's standing out to you lately in this market when it comes to ETFs?
Well, I definitely want to ask them for sure.
Yeah,
Why would we come to me and
questions
do
you
that?
have
Can we pull up the website though? I just want to talk through the ETF space and what's happening. There's a lot of stuff going on. I was talking with Bilal a little bit through this. Like there are a lot of ETFs that have been launching over the last couple months, even just June, I know was probably a month. I saw some stats around ETFs and even maybe it was IPOs I'm thinking about, but I know there's a lot of ETFs being introduced to this world, from the crypto variety to whatever. But so I wanted to hear some of the thoughts around what's going on, how the numbers have been, and what some of the latest ones is where my questions really would end up going here. And then also I would love to go through ETF Central and kind of dig into a lot of the stuff. And we also are live, so there is a live chat and we can kind of hear and listen. So if there's any ETFs you guys have been fans of and want some thoughts of, or just whatever in general. But that's kind of my general thoughts for this conversation, Gav, is just talking about what's going on in the ETF world now, some of the newest products coming out, what they look like, some of the most popular products look like. I'm also curious on the type of companies that have changed. Obviously, there's the BlackRocks and the Vanguards, Gav, but there's a lot of these newer firms that are doing different, interesting stuff, moving quick. And then you see some of them come in and take it. So, Gav, that's where I would everything in a nutshell that I kind of want to talk about.
All right, perfect. Well, then this is the right screen for us to be on right here. I'm on ETF Central looking at the segments on the move. Tony, could you break down for me what we're seeing here?
I am seeing a very much buy real assets trend here with the increasing geopolitical volatility that has essentially taken the market over since the initial invasion of Ukraine. We've seen it extend with Israel-Palestine, with the recent conflict between Pakistan and India, and then the surgical strikes on Iran by Israel and U.S. coalitions. You're seeing a lot of continued momentum in gold and also energy commodities. So on ETF Central, this segment includes both futures-based funds, the ones that roll, say, like West Texas Intermediate crude futures or natural gas, but also explorer and producer commodities and upstream, which tend to have a lot of correlation to spot prices. We tend to see that when geopolitical volatility picks up, these segments tend to experience higher inflows and correspondingly better performance. So it's really been the prevailing theme. And I think unless you believe that tensions are going to materially de-escalate, and that's a big if given how much money is flowing into defense, I think investors are going to continue looking for hedges to geopolitical volatility. And I'm going to be very on the lookout for when an issuer decides to launch a specific multi-strategy ETF that is designed to hedge this, maybe a combination of core portfolio and defense stocks with some added sleeves in gold, futures, or even long volatility. So that's one of the opportunities that I'm looking at here.
Beautiful. And I know I'm glitching a little bit on mine.
No, let me jump in here.
Bilal, if you want to jump in off that'd be perfect.
Wow, you guys had the same mind, lagging Gav and Bilal. There we go.
Yeah, look, I think Tony's points are extremely valid as far as looking at where flows go. I think typically when you see flows, you get sentiment of the market where the money is loved most, if you will. The best way to think about what's taking place in the ETF landscape, I think people need to take a step back and realize that there's been significant growth in the actual wrapper and the vehicle itself. And just to give you guys context of sort of what's happening in the market right now. So you have buffered products, you have single stock leverage solutions, clearly you've heard about the introduction of private credit and obviously different types of crypto. But to Tony's point, I think this is very important. Multi-sector or inverse products will start to come in a larger wave. The big stuff that you continue to see right now is the buffered products. But to even give you more context of sort of where we are and where we've been, last year we had 750 launches in the ETF space. This year we're on pace to do over 1,000. This might be the first time in history that you might have more ETFs listed here at the New York Stock Exchange than you actually do corporates. So you're seeing a massive amount of volume of new products coming to market and innovation with the ETF wrapper. More importantly,
well, I'm just curious. What does that mean by corporate? There is that like you're saying like for like institutions,
individual stocks? No, so there are about 2,400
okay.
individual stocks, corporate listings. So we have literally over approaching 2,400 ETFs as well. So just to kind of give you some context of the month of June, we had in the industries 117 ETFs actually launched. A lot of them, the majority of them, were single stock levered products. And that's been the sort of soup du jour of the day. But more and more buffered products and defined outcomes, if you will, are coming to market, as well as option-based strategies. Managers like YieldMax or NEOS, these are new entrants to the market, Evan, to your point, that are picking up a lot of momentum. Legacy managers like BlackRock, Vanguard, State Street, the key players in the space, they continue to garner, they continue to innovate. The top 10 money managers still pick up a lot of the flows. But what we're seeing is we're seeing new product innovation happening, touching different parts of the market, addressing specific needs, if you will.
And you're definitely seeing them get more creative, obviously. And I'm also curious. I want to ask a little bit on that. How have you seen this year in general feel different and look different on the ETF side than prior ones? The kind of question I'm asking here is about the new administration. Obviously, crypto ETFs have become a different flavor, but once you kind of let them in with a single stock leverage, boom, it goes out. Once you let them in with these kind of single stock income ones, there's 50,000 different things of that. So I'm curious, maybe Bilal and Antonio, I'd love to hear your thoughts as well on like just what you're seeing this year versus prior years and how it's different. And like, I don't know. We're now more than halfway through the year, which is a little scary. But what the rest of this year could still look like, it might not still be fully written.
So what ETF Central's or Track Insights 2025 annual ETF survey found was that the launches in this space are exactly what Bilal described. It's a very bimodal, or I should say, it's very barbelled kind of a product environment. You have on one side of the risk-taking spectrum these leveraged single stock products, and a lot of them are just synthetic based. So they just use different legs of options like flex options, or they use futures and swaps to deliver synthetic exposure without actually owning the underlying for capital efficiency purposes. And then on the other side, you have other ETFs that use the same legs and combinations of derivatives, but instead of providing magnified exposure or enhanced income, they're doing this to limit downside risk. And that falls into not only the buffer ETFs, which have a defined date that you need to buy them by and hold by to get the full outcome period, but you also have other more traditional hedged ETFs that use options ladders. I think JP Morgan has two. One's called Hilo, and that is the ETF version of a very big mutual fund called JHEQX, which the options trades this fund makes are so big that it catches attention and people try to front run it all the time. But that's an ETF form now, and at a much cheaper expense ratio without the 1 million minimum that the mutual fund has. So I think the term they call this is boomer candy. You have basically two sides of the investing demographic. You have the younger investors who are risk takers, who have that tax sheltered room, who are willing to use these strategies that they otherwise would be doing on their own. If you look at Wall Street Bets, people were buying speculative options before. People were creating leverage on their own with options and with margin. People were selling call spreads and put spreads. Well, now you can outsource that to an ETF, and that's often much easier to size your position. And then for the older investors who maybe traditionally relied on the 60-40 and then watched that fall apart in 2022 when interest rates and inflation rose aggressively, these options-based, hedged and buffer ETFs are providing a more mathematically defined floor on your losses. And the biggest trick for advisors is to how to integrate into their toolkit. And it's something that the issuers are still trying to figure out too. So you'll see education around this evolve as time goes on.
I'm
Yeah,
curious.
let me jump in here.
Oh, sorry, go for it.
There's some on the back of that. So to Tony's point, portfolio construction is the missing component of the conversation with ETF launches. Everyone's sitting here talking about, hey, I have a new product, but how does that fit in my risk profile? That is what you see from a change happening in the industry. These buffered products historically are insurance-based products or bank products for the most part, right? Defined outcomes. We want to know what our risk is. So you're seeing more entrance into the space with that stuff. But in addition to that, you have another component, and Tony, I wanted to share this as well, is you have the explosion of commodity ETFs. Right. Historically, the commodity exposure was just gold, but now you're seeing a lot more focus on precious metals as well as some of the soft commodities as well. So people are looking to diversify the portfolio with that as well. I would also argue you're seeing a significant growth in bond issued ETFs.
Yes.
The bond market is significantly larger than the equity market. Everyone knows that. The Fed follows the bond market. They don't lead the bond market for whatever reason people assume otherwise. The other component about that is legacy mutual fund managers that manage money in fixed income thought that there was some sort of unique value to having a lot of transparency in their portfolios. They're now coming and ushering in the value of the ETF and starting to talk more about the trading components on the market making side and the structure side. That is where the value is had and differential from a product perspective. So you're going to continue to see launches there as well.
Absolutely a big push into active fixed income. I think this month alone, we've seen new ones from Vanguard, from JP Morgan, from Capital Group. And one thing that you'll notice about a lot of these active fixed income ETFs is how cheap they can be. You can now get active short-term, ultra short bond exposure for 11 bips, right? And you compare this to the legacy Core Plus mutual funds that were many multiples as expensive, and they often were significantly less tax efficient and came with high investment minimums. So I think that given the opacity and the over-the-counter nature of the fixed income market, this is somewhere where a good active manager in the ETF space can add a lot of value for advisors and retail alike.
Yeah, I love that, Tony. Quick question for you, and I'll turn it back over to you, Evan. So fixed income seems to be a big theme. Leverage seems to be a big theme right now.
Yep.
What else is coming into the picture?
More smarter, Bilal touched on this briefly, but a more smart commodity strategy. So if you think about before when GLD was released, that was, the first physically backed one. And then you saw some futures-based products, and a lot of these suffered from severe contango. And it was just how they were designed at the time. They were very limited. They would just hold front-month futures. They give you a lot of correlation to spot prices, but most futures curves, especially for commodities, are in a state of contango. So the further out you go on the curve, the higher the prices go. So as your front month future approaches expiration, it merges with the spot price more and more. And if the spot price is lower than the next contract, well, when you sell, you're selling low and then you're buying high. And that's what you get your negative roll yield. And that was a problem a lot of allocators had with the old commodities ETFs, is that if they held them for a long time, they would face very, very significant negative roll yield. And that's a structural drag that kind of nullifies the diversification benefits you want. So ETF issuers, took this to note, and they developed more sophisticated indexes, or in some cases, like a Harbor Capital with a HGER, some very good proprietary quantitative-driven benchmarks that, they're called indices, but they're so sophisticated at this point and not like the ones before. And what we've seen from them is that an ability to manage this roll yield better, while still maintaining a low correlation to equities and bonds, and giving you the necessary volatility so that even a small allocation of 10% can meaningfully move the needle in a diversified portfolio.
Let me just jump on the back of that. If you look over the last 3 years, a product like a hedger, to your point, made total sense if you look at what fixed income did as a true diversifier from your equity risk. But at the same time, with a weakening dollar, you're talking about maintaining your purchasing power over time. So it's a better way to diversify the portfolio. And just to speak to Tony's point, I like to use space, to break things down very simply. If you look at liquid natural gas, for example, over the last 30 years, that contango situation has been a terrible trade. But yet, if you just hold BCOM, the static index, you're going to have exposure of 10, 20% that, to Tony's point, if they're not making dynamic changes in the portfolio, you're going to have a laggard inside of your portfolio. So Harbor is doing very smart things with the way that they manage and allocate to commodities. So that's just another great example.
Evan, I'm going to turn back to you real quick for Bilal. The sound's a little fuzzy on your end. I don't know if you have like AirPods maybe or something that you could try, but just putting that out there. Evan, let me turn it back over to you. Some great insights here on things that are coming through and happening inside of the ETF world.
Yeah, no,
Really,
actually,
yeah.
one of the things that I wanted to ask on before you go off topic, the buffer ETFs. I saw Kathy Wood launched a buffer ETF, which I know you guys took it into the commodities direction. I saw a face by Tony. It might have just been normal one, but you got any thoughts on these ETFs? I don't know if you saw them at all.
It's I like Kathy Wood. Like I'm not a thematic investor or a growth investor, but I respect Kathy Wood on the basis that most of her funds maintain very high active share, and she takes concentrated, conviction-driven positions. If I'm going to pay 75 bips for active management, I want something meaningfully different from the benchmark. As for the buffer ETFs, when you buy a buffer ETF, you got to make sure you're comfortable with what the reference asset is. If you are an investor who was not going to invest in ARK in the first place, I'm not sure if there's a reason for you to buy a buffer ETF with ARK as the underlying. If you are and you want to limit your loss, and then you otherwise would have hedged with options yourself on ARK, this is a good way to outsource it to someone who intimately knows the product and probably has years, if not decades, of derivative experience. So my suggestion for any of these buffer ETFs is be comfortable with the underlying. There's no point in buying, saying, a buffer ETF pegged to the NASDAQ 100 if you yourself are not inherently bullish on large cap US tech growth. And that extends to whatever ARK is doing with these buffer ETFs.
You've written about a lot of you've written about a lot of ETFs
Go for it.
over the last few years. I'm curious if you had to like pick a few that were the most unique. Why did they stand out to you?
I think one of them on my list right now is SVOL. So the Simplified Volatility Premium ETF. Short volatility ETFs have what I would call checkered past. In 2018, a whole number of these blew up. And to be fair, a good number of them were exchange traded notes. And these are structurally designed to, well, expose you to a lot of left tail risk. That's where your premium comes from. You make a lot of steady gains as volatility falls, and then contango works in your favor when you're short. And then one day when volatility spikes, you could pretty much lose 90, 100% of it. XIV, which was the ETN issued by Credit Suisse, was delisted. And there was a survivor from ProShares called SVXY. And then after Volmageddon, it had its exposure reduced to 50% of notional instead of 100%. SVOL is a bit different. Instead of just purely going short VIX, Simplify restructured it so they changed the core of the ETF to be kind of it's almost like a macro hedge fund. It's got a whole bunch of their other fixed income and equity strategies, and that's just meant to support the net asset value a bit. And then they have the collateral for the short VIX futures exposure, and that's where a lot of that 20% yield comes from. You're directly shorting volatility, and there are environments where that works for you, especially in a low volatility upward trending bull market. But unlike some of these ETFs that blew up during Volmageddon, SVOL actually hedges. So they have out of the money VIX call options, which are laddered. And theoretically, that should keep the ETF from completely imploding. When the whole April tariff tantrum happened, I kept an eye on this thing throughout, and it actually managed to hold up pretty well, better so than some of the competitors with a different strategy. And another thing I like about SVOL, the final thing that I'll note, is that unlike a lot of these other short VIX futures ETFs, this does not spit out a K1. At tax time, you get a 1099, which is significantly easier to deal with. But again, like it's just SVOL is just kind of what I consider
Really,
to be
that sounds so interesting. So you get
for alternative income.
You get a 1099 from this?
Yep, no K1.
That's funky.
You got to be real careful with these because the ones they don't tell you if they get a K1 like in the name. You got to like really look in the details. I've had friends who've traded SVIX, and they'll be like, "Hey, what's this thing I got in May?" I'm like, "Oh, that's a K1. Have fun with that."
Jeez. Yeah, I actually hadn't really dug too deep into the areas there on what tax documents are providing to you. Yeah, go for it.
Let's be real, Gav. Like, we're as a retail side of it, and I kind of want to ask you a question here too. Like, there's a certain type of ETFs we're going to be looking at. I don't know if I booed in my head when we brought up commodities or like bonds or something like that, but I feel like that's the general reaction you're going to get from retail. So this whole side of it, I really don't know much on. I'm curious on like who's also buying a lot of this stuff. Obviously, my perspective comes at someone who's, has a longer time frame. So for those people who are in less than 5-10 years, kind of looking at that area, it's a very different conversation. And the other, I'll kind of leave that there. The other question I want to ask of is what some of your largest ETF holdings are.
Yeah, so I'm happy to dive into that. My largest holding is essentially VTI, just the BlackRock version of it, but it's every major publicly traded company in the United States. Because,
Are you saying you're in mutual funds or index funds?
yeah, no, I mean, the largest portion of my net worth is in index funds at the moment. Now, it's not to say that I don't have plenty of individual stocks that I pick and trade and have details along those lines. And I do have that portfolio separate, but kind of that retirement fund for me is stacked up in those index.
My question though, I want to know, is it a mutual fund or an ETF? Or a lot of those ones in mutual funds or ETFs? I want to get the other guys' opinions on mutual funds in general, maybe. But yeah, because I know you have some money managed by someone else.
No,
but we got to put
no,
them
you're
on
good. They're
blast.
still ETFs. Yeah, like it still leans ETF
Nice.
for me. Yeah, but I would be curious to hear from the other guys, and I can go through a few of my others. But I mean, the majority of mine do center around all publicly traded companies in the United States. I will note that I do have exposure to emerging markets, which did nothing for me the last couple of years and has finally started to perk up this year and provide some decent returns. So that's nice to be seeing that. And then outside of that, I do have some muni bonds as well, which, by the way, I feel like I listen to a lot of these interviews with, uber wealthy billionaires, and it seems like they own a ton of muni bonds. It feels like it's a big area there. Is something you guys have seen?
We tend to see that more by state specific. So two of the biggest popular categories for muni bonds and ETFs, at least, are New York and California. Highest state income tax rate. And for high net worth investors in these states, allocating to state specific muni bonds will give you a significant tax equivalent yield pickup, almost as much as 6-7% in some cases. So that's how much a taxable bond fund would have to pay to rival the tax sheltered yield from a muni. And then we can get into like really high net worth earners. There's AMT free muni funds, which stand for alternative minimum tax, is a parallel tax system to ensure that you can't just use as many deductions as you want, just paraphrasing. But yeah, it's a lot of state specific, and the big providers, Vanguard and BlackRock, have really cornered the market here. One thing that I always found interesting was that someone like an issuer like Nuveen, which is a lot of experience in munis and has a lot of closed-ended funds, but we haven't seen that same push into it yet. So I'm on the lookout for that. I think that once they realign the strategic priorities, we might see some more launches there from PIMCO, Nuveen, and here, but it remains to be seen for now.
You're on mute.
Yeah, you're muted.
Classic.
Sorry, one other question that came to mind while you were talking, and it's a little bit of a different topic, but Evan, just because you were kind of digging in, I was thinking about the ETFs that you own, Evan, and correct me if I'm wrong, but QQQ, is that your biggest holding?
Mm-hmm.
Okay, so QQQ obviously gets a ton of attraction. And this is one of the reasons, by the way, that I really do love poking around on ETF Central lately, because I've been able to go in and I can just like actually look at all the flows and see what people are doing and things along those lines. And you can look at QQQ and you can see, almost $250 million here in just the last 5 days, but still down that 691 million in the past 1 month. So that's really interesting to me. But have you seen, Tony, this kind of entrance of ETFs where they take a set like QQQ or like SPY, and then they'll remove out certain names? So the idea is like QQQ minus, I don't know, all the companies that have
There's
certain
BlackRock.
practices.
BlackRock launched one today. I find it kind of dumb. I'm curious, these guys, the S&P 500 X the top 100. So take out all the biggest winners. Seems like a good strategy. I'll not a leading interview question.
I'll let Bilal take this one first before I give mine.
Yeah, let me just share my screen really quickly on something that I think would be appropriate for the conversation. If I can't share it, Gav, you may have to go.
Yeah, just let me know.
No, you can just go back to the comparison chart on ETF Central, and I kind of want to address Evan's question about commodities, just to give an example. So there you can actually compare QQQ as an example to Hedger, HGER. And I just want to have a conversation briefly around portfolio construction. So every single day, every single week, every single month, we know it's time in markets, and we know that we need to pay attention to how things change, maybe on a quarterly basis, right? That might be the typical timetable that we all look at, saying, okay, look, here's economic data. Let's reevaluate some things. I want you to click year to date for me on that chart. And I just want to point to the impact of loss. And Tony, you can unpack this even further, but the impact of loss is where I say the next gen of investors miss out on, to your point, Gav, what are really wealthy people thinking about? If I lose 10%, I have to make 11 to get back to even. If I lose 20, I have to make 25 to get back to even. If I can limit my loss on the downside, I'm sitting here showing you a commodities portfolio. If you would have peeled off, let's say 20% of your QQQ allocation, I'm not telling you to do this, I'm just using this as an example, you could have saved yourself some loss, added diversification, and then likely had a better ride up. And then you can rotate on a quarterly basis depending upon market dynamics. What's missing in the conversation is how we evaluate product by product and how asset classes move in alignment with one another. And that's where you de-risk the portfolio, you properly build in diversification, and you use investment solutions that meet and fit your demographical sort of structure and need.
Yeah, I like what you're saying there, right? Because most people might have not even thought to rotate out of it. They might have just
But
thought to continue to
I
buy that
think
dip.
one of the things I'm noticing about 2025, and maybe it was before, I'm just maybe paying attention more, is any strategy like that, set some rules, turn it into an ETF. That bar seems pretty low. It's obviously still actually pretty high, and it's continuously getting lower. ETFs are expensive, I know, but like that type of thing, I wouldn't be surprised if that becomes a strategy, because I definitely see what you're saying here, and I'm sure you can codify that into some rules, back tested, and create a nice little thing.
It's going to happen. We have multi or so-called fund of fund or ETFs of ETFs, multi-asset allocation strategies. But
Have any of
one thing,
those, Tony, have any of those been successful so far? I've seen a couple, but I
yeah,
haven't seen
actually, if
any
you
break
Google,
out.
if you search AOA, the iShares aggressive allocation, that is a 80-20 fund. But to my point, or to Bilal's point, it's just equities and fixed income. There's no meaningful allocation to commodities or any kind of active alternative strategy. And yeah, maybe in the days of mutual funds where these things had 2 and 10 carry, 2 and 20 carry and stuff was inefficient. But we're seeing a lot of these alternative ETFs get very cheap. You can get a KMLM, which tracks the MLM, the Mount Lucas Index, managed futures. And that's available in an ETF. There's no carry fees. There's no hurdle rates. It's just a flat expense ratio, and it's liquid. There's no redemption gates. None of the things that we've seen that pretty much gate-kept alternatives in retail in past years. And to that point, like as with QQQ, I'm looking at a back test right now. Did you guys know that since QQQ's inception at one point, it would have been down 82% and underwater for 15 years? You could have sent a kid to high school and still been underwater on QQQ if you bought at the wrong time. And averaging down wouldn't have helped. But like to Bilal's point, even though HGER and other more sophisticated alts didn't exist back then, even a modest, say 10% allocation to gold would have meaningfully reduced your drawdown and your volatility, simply because it is not perfectly correlated to the Qs and it is volatile on its own. So you capture a rebalancing bonus if you manage your portfolio in a systematic manner. That's what a lot of the pros do. All they do is take a combination of volatile, non-correlated assets in the right proportion, so each contributes the desired amount of risk and return, and they systematically implement that and rebalance at set periods or with set bands. And, as a retail investor, learning some of these principles can significantly help you weather these ups and downs instead of just being 100% in equities.
What do you see just on the one that you mentioned real quick on that
think-
AOA? I noticed that there was this pretty crazy change in regards to flows. You could see like all these outflows, and then it just completely swapped here. Did you notice that? Do you find that
I did.
interesting to see that?
It's I try not to read too deep into these, especially for these funds of funds. It's
Just to help you out on this, Tony.
Yeah, go ahead, Bilal.
So even within BlackRock, so I spent 7 years of my career at BlackRock. A lot of the models, what they do is they may sort of add their model, these types of allocation funds into some of their model portfolios. So that could have been a model change that you see when it comes to the flows.
Got it.
The other thing that I wanted to bring to the attention of everyone, because we're talking about portfolio construction dynamics, let's just kind of extrapolate and think a little further into the portfolio right? We all have home country bias. This is where we live. This is what we think about. But the international markets have done extremely well. You could have held several parts of the emerging markets and done exceedingly better than the S&P 500 as well as QQQ. And what I want to make sure that we press upon to the audience is to think about the other aspects of the portfolio as you diversify, because we are a global society. And there's a fantastic opportunity to pay attention to dynamics of a weakening dollar and protectionism that actually benefits other parts of the country or other parts of the world. So you could have held Brazil, you could have held India, you could have held a lot of different places. And that's the unique aspect of the ETF wrapper. It allows you to go niche into markets and build a portfolio that best represents your overall views and risk profile. So I just wanted to put that out there because there are 45, approaching 4,500 ETFs in the U.S., $11 trillion total. They're generating 19 billion. We just talked about 800 products being launched year to date. We're going to surpass 1,000. We are all focused on the top 5 or 10, but there are so many unique options out there for people. They just need to understand that they are available to you.
Yeah, it seems like everybody's in the mix now to launch. Do you think that that's just going to continue to become something that just adds and adds? And Tony, do you want me to share that? Yeah, there you go.
Yeah. I just wanted to press on Bilal's point. A lot of people discount international diversification because of the historical returns. Notwithstanding that that's completely illogical, it also has to do with whether or not your international ETF was currency hedged. So just bear with me for a moment here. I have an ETF that is holding European and Japanese equities from the EAFE. Okay. Those are denominated in foreign currencies, but the ETF is in US dollars. During a period of strong US appreciation, say over the last decade, where the US dollar just destroyed everything, whatever returns those underlying stocks do in their home currency, when it gets converted into US dollars, it's going to be doing so at an unfavorable rate. And you are fighting that headwind every step of the way. But in contrast here, what I have is a back test of EFA, which is a very popular EAFE ETF for, Europe and Australia and Japan. And then I have DBEF, which tracks the same index with the exception that the currency risk is hedged away. And you see the massive difference in performance. And again, this is a decade where the US dollar has destroyed every other currency. So if you hedge away that headwind, it turns out that the underlying returns of those international stocks aren't that bad after all. All right. And this is one of the least understood aspects of international ETFs, that a lot of providers have painstakingly gone out there to create these currency hedge versions so you can gain the benefits of international diversification without fighting the US dollar, as it always should have been. And it's an unfortunate fact that a lot of investors don't look past the headlines. They flock to the biggest funds on the market that are unhedged and have been around. They have high AUM and a long track record, but they are structurally disadvantaged when the US dollar is appreciating. And that is one of the few things that I do not want to bet against.
That's super interesting. How do you think people can, like, when you're talking, it's got this, but the difference is currency hedging. There's two sides of this to me. One, it's, hey, this is why we use ETFs, is because as the end user, you don't have to do it yourself. Someone else can. But at the same time, you want to understand what you're investing in. So how do you think people can kind of align their knowledge with what they're investing in?
I think this one's on the issuers, actually. The issuers have gone through the efforts of making what is a fantastic product, but the education has fallen short. Not in terms of quality or quantity. There's been plenty of great white papers and articles, but it needs to be in a format that more investors, especially Gen Z, can digest. Gen Z is not likely to pull up a
live stream or a Spaces.
Yeah, live stream
Some
on
ideas.
Twitter, on YouTube,
Someone's
on TikTok.
saying.
Right? They are more likely to do this than go to the issuer's website and then click that little tab that says, yes, I am a financial advisor, to access the white paper that actually explains what I just told you right here. Because in order to find this information, sometimes that's what you have to do. You have to click all these things and say, yes, I am this, and then download it and then read it and stuff. I'm sure there's compliance guidelines around there. There must be a reason for it. But if people want to know more about these tools, then I think the fund issuers have not an obligation, but perhaps a strategic priority to explore more mediums for ETF education. Because not everybody learns by reading. I'm a writer, but I know that there's some people that just can't sit down and read. I used to be one of them. So sometimes I like having things explained to me live.
Yeah, that makes sense to me. It's definitely just an education problem here because there's so many great products that are out there. And I love that these ETFs are taking what beforehand a lot of times probably was just somebody needing to have a private money manager, right? Figuring all this stuff out for them and just kind of providing you all these options. There also has been a lot of movement in the fee sides of things, right? And so you did mention before, and you're like, hey, if I'm going to pay a 70 a point basis fee, at least I want someone that's taking, something, a different approach, right? Concentrated conviction, kind of talking about Kathy there. You're also seeing up to, 1.3, 1.4 on some of these funds that are, using leverage or selling covered calls. And then, you can go as low as whatever it is, 0.03 on like something like SPY.
Lower,
So
lower.
low
BNY,
0.003. What is it?
Yeah, well, no, BNY has two zero expense ratio ETFs. BKLC, which tracks a selective index, or is it selective or something else? I don't know. A low cost index provider, and BKEAG, which is Bloomberg Ag exposure, but for 0 basis points.
So you're clearly very educated in this area. How much
So
do you
can I
pay
ask you
attention to
something
the
though?
fees?
Is that just a loss
Not
leader? Is
temporary.
that a, is
No,
that a,
it's been on the market for years. It's one of the
what?
best known secrets in the
Why?
market.
Question mark.
Why? Well, they're able to do that through two things. One, not tracking a big box benchmark provider. So when you license something from S&P, it's expensive. That's where a lot of index ETF fees come from, licensing the index. If you use a different index provider, and as to be fair to Selective, is kind of like picking RC Cola over Coca-Cola. But in this case, the difference in taste is that much. It turns out when you get a basket of the 500 large cap US companies that market cap weight them, even though the S&P 500 has some liquidity and earnings rules, the net results are kind of still the same. And the second thing these ETFs do is that, like the Fidelity Zero mutual funds, they only sample the index. They don't fully replicate. That cuts down on your transaction costs. And the third thing they do is they can lend securities, which generates additional income to offset operational expenses. We have seen zero expense ratio ETFs before, but as you pointed out, these were temporary waivers. I know SoFi did that for a few of theirs, but the BNY ones have been on the market for years and they're still zero fees, but you don't see them advertised. And they're not small by any means. They're billions in assets.
Wow.
Yeah, zero fees. I don't know what you're advertising, getting the money to advertise from, but I guess the other way
So
is I
it's all
didn't think about the lending.
It's kind of like having, free DoorDash delivery and not advertising it. You got to put that out there. Okay, wait, real quick, just a question I was throwing in there. So Tony, you're clearly very educated in this area. You've done a lot of research into different ETFs. How much do you pay attention to the fees, and how do you think about them?
Not much. No. Well, it depends on what you're looking for. I separate my holdings into two. One's called cheap beta, right? You know that a majority of your returns are going to come from exposure to the market risk factor, right? Just owning equities long term. So for that, I don't want to pay anything. You can get S&P 500 exposure for 2 basis points with SPLG, or you can use that BNY ETF I talked about. For active, I don't really have an upper constraint on it. If it's within the industry norm, I'm okay with it. What I do look for are two combinations: high active share, so a portfolio that is meaningfully differentiated from the benchmark, and two, low turnover. I want to allocate to managers that buy and hold. A good example is actually listed on the NYSE. It's called a DSTL, the Distillate Capital Fundamental Value and Stability. Uses a free cash flow methodology, but it's not index-based. The end portfolio of 100 companies is fairly concentrated, and the exposures are unlike the index. And unlike most value ETFs, this one is beating the Russell 1000, and it's also, at one point, it was beating the S&P 500. It's very, very slightly lagging it now. Very slightly. And this is after a 39 basis point expense ratio, which, if you think about how much active value mutual funds were before, like 1%, 39 basis points is nothing. And this is a perfect example of the value that active ETFs can bring, especially in a satellite allocation. Without ETFs, distillate capital might have just been for RIAs only. They might have been only open to family offices. You may not have had the chance to invest with them, but now anybody can. And they're one of my favorite boutique active managers out there at the moment.
The performance versus flows is kind of funny to look at because, like you said, it just keeps going up, but people seem to be moving out of it.
Yeah, people flee when strategies hit headwinds. Fortunately, the ETF's creation and redemption structure prevents a lot of the issues with embedded capital gains we saw with mutual funds. So you had a high-performing mutual fund in the past, people buy in, it starts underperforming. When people sell, the fund manager has to sell holdings that have previously appreciated to meet redemptions. And that triggers taxable capital gains distributions for everybody. With ETFs, though, you can do that in-kind creation and redemption, completely sidestep those. So while outflows aren't great for you as a fund manager, you aren't going to get screwed if other investors in the same strategy leave out the gate, unlike a mutual fund.
Makes sense. Bilal, you're talking with fund managers every day, it seems. I always see you having these conversations. You're doing pods with them. For people that are looking to bring new funds to market, what's the biggest concerns that you're hearing from them right now?
It's a great question. One, most of the legacy mutual fund issuers have come out and said that they don't plan to launch new mutual funds going forward, which is very interesting. We're talking about the wrapper of the ETF being extremely innovative. And basically, back in 2019, 6011, also known as the ETF rule, basically allowed ETFs to act as a unique wrapper as a mutual fund, similar to a mutual fund. And it's pulled in a ton of active managers that legacy would use the mutual fund, which will now use the ETF wrapper. It just streamlined the entire process. That's why if you look at, call it launches since 2020, 2022, you see a significant upswing as far as what the launches look like. Obviously, there was a lot of volatility in 2020, but following that, they basically said, hey, how do we get our ducks in a row? How can we get to market faster? What can we launch? And how can we basically embrace new innovation? So that's why you see so many different types of ETFs being launched at this particular time.
Yeah, it does seem like people are moving into, I think people just want to be in that asset management side of things and culminate assets without having to necessarily set up a whole, financial advisor shop and pieces like that. It seems like people are seeing this as a more straightforward route.
Yeah, let me just kind of give you a lay of the land of what that looks like, right? So legacy mutual fund managers, you have to think call it 2020, call it pre-2010, everyone had to go through a financial advisor to buy a product. That's why they were known as stockbrokers, and there was a commission paid on it. And then they did what? You go through separate accounts and you go through mutual funds, and these advisors, you're charging advisory fees because I have access. It's almost gate kept that I can buy this investment for you. So the advisor was extremely important. I'm not saying that the advisor is not important because you still need estate planning needs or whatever. But what I'm saying is the ETF it allowed the retail investor or self-directed investor to go direct to market, identify an option that they wanted to buy, and they can allocate capital. And that's why you see the massive explosion of Webull, Reddit, Webull and Robinhood and so many other platforms, because now you guys can get together, you can learn on your own and say, you know what, I want access to that. You have people who are not gatekeeping access to information. And that's what the ETF wrapper is doing. It's actually democratizing the access to capital.
Bilal, I wanted to run this past you. How do you think the role of wholesalers in our industry has changed over the last decade?
No, that's a very loaded question. I'm a former wholesaler, so I've wholesaled at BlackRock, I wholesaled at Neuberger Berman and Harbor Capital, so I know all those firms fairly well. I've been in the field for 18 years, and I've raised about $15 billion for those managers. So it's changed quite a bit in the sense of the advisor is now focused on growing and running a business. The value in which they give their client is spending more time with the client, learning more about the family, other ways to solve more complex problems. The investment is one component of it, and it's not the largest component of what they do. If you look at any advisor, their real value proposition is very simple. It's to manage, protect, and transfer wealth. And the only way you do that is with proper paperwork. You don't necessarily control the investments. They can try to figure out building a diversified portfolio and identifying the best investment solutions that represent your needs. But the truth of the matter is they're spending less time there. So what happens to the sales and distribution people who are an expensive overhead? They are calling and they're emailing the 200,000 financial advisors with similar products, but they're just talking about, hey, look at my product, look at my product. They're just trying to get visibility for the product. You need to build a relationship with the advisor, and you need to add value for them to want to usher you in and then introduce their product into their clients. So the reason that sort of is happening that way, you see margin compression, right? You see fee compression across the board, and you see the advisor focus on an asset gatherer, not an asset manager anymore. And that's the unique aspect of wholesaling. So now you have younger people in the field. They're traveling, they're calling, they're emailing. But think about the amount of emails that you get, all of you, everyone on the call. You get too many emails. Everyone's just selling product or selling something. So now you only need to be able to cherry pick the things that are unique or valuable to you, and that's the different component of it.
I think some of the the newer entrants, I guess, they're not exactly new, as in they have a decent record, but I've noticed this shift you've described. For instance, at Pacer, like their wholesale team is just like firing on all cylinders, and they do use that collaborative approach you talked about. They're always willing to hop on calls and stuff. And it'll be interesting to see how some of the more, not legacy, but some of the older, more RIA focused firms adapt to this new medium. And I'm excited to see if they will choose to use any new mediums. We're seeing more issuers open up Substacks to have periodic blogging content, to have their own content generation. A lot of firms are hiring executive positions for content creation now, as opposed to outsourcing that. So it's a very interesting time.
They're all looking at that. I think that's the frontier of distribution, right? It's media amplification and brand awareness, and how they do that for a business that historically, leveraged an intermediary channel, which is the advisory channel. So when you think about Merrill Lynch, UBS, Morgan Stanley, those are very, very big businesses, and that's where the bulk of the assets are. So it's almost like you guys remember there's like a famous bank robber, but I forgot the quote. He said, "Hey, why do you always go to the banks to rob the money?" He was like, "Well, that's where all the money is. Where else would I go? Right? That's where you would go to sell your products." But now, with the emergence of the self-directed investor and content creators and influencers, these are real viable areas where people can actually go out and position their product to be in front of new investor audiences.
Listen, if we want to talk something good in our area too, one thing I'll say is, as someone in this area, we see advisors in our audience too. We see a lot of these people who, like I'll see them kind of. We'll talk about the one of these new products that come out, and then they'll kind of go in and add it in. So I think also, first of all, I was a financial advisor for a very short second there, so maybe I'm a little bit more sympathetic. But I would say the younger generation is definitely not a fan of financial advisors, or at least don't see the value that they bring in. I definitely see it more as all that paperwork and all the accounts and everything, and getting you in the right area. But when I probably will set my money up with an advisor at some point, but I will want to be the one who is giving input. And the question is where am I getting those ideas? Me personally, it's X, Twitter at this point, and there's probably a couple other areas, but I also think the person who's Wall Street has definitely come around to, hey, there is a very large retail individual stock shareholder base, and you're definitely starting to see that more in the ETF world, but definitely is there. And I'd imagine, I don't know what percentage of ETF AUM is retail versus kind of institutional ownership, even through these RIAs, and how that changes, but I'd imagine it's definitely going closer to more retail ownership.
Depends on the firm. So, for instance, you look at a provider like First Trust. A good number of the assets in their ETFs are used by advisors. A good rule of thumb is if I see an ETF that is pretty big but is never mentioned, for instance, FTCS, which is the First Trust Capital Strength ETF, it's got like 8 billion AUM. You never hear about it, but that's grown like that for a while. That is most likely allocated by advisors. It's not retail touching that. It's a strategy that advisors have been using in model portfolios for quite a while now. I do have a financial advisor. I don't talk to him for investment advice. He knows to stay out of that. But for tax, for estate planning, for cash flow management, for budgeting, it's worth its weight in money. It's absolutely worth it. And I'm more of a fan of the fee-based model. I don't like percentage of AUM, and there's endless debate around that. Right. But I will say that in order to get young people's business, advisors need to not be turning people away for not having sufficient assets under management. This gatekeeping, it doesn't help anybody. And we also see, for instance, in Canada right now, there is a concerted effort by the advisors and their industry and their lobbying efforts to kind of discredit finfluencers. And I get it; it's kind of warranted. There's a lot of bad advice going around, but it's the stick approach without even trying the carrot in the first place, and it doesn't look good. And I think that any attempt to gatekeep or do these protectionism theme measures is going to do you more harm in the long term than a collaborative approach where you proactively identify pillars in the community that retail looks up to and you work with them to expand your practice. Everybody wins in that case.
Tony, to that point, there's actually an article from the World Economic Forum on the future of financial advice. And it actually talks about this collaborative approach. So you're spot on. And I want to echo one other thing that you mentioned. Everyone is so focused on growing wealth. Stock traders, everyone, we all want to grow our wealth. That's 100% true. But the most significant aspect of life is you will transition on at some point. So having your ducks in a row or your paperwork in order is the most significant aspect of wealth creation that you can actually do. So to Tony's point, and I'm glad you actually said this, it was actually music to my ears. Young people who are building their investment solutions today, no matter what it is in stocks or ETFs, paperwork, should something happen to you, is the most critical aspect. Because who knows what to do as soon as something happens? Who has access to all your crypto? Who has access to your stuff? Who can tell your parents where your paperwork is? Like, it's going to be buried, and it's going to take them forever to work through that. So the value of a financial advisor is really critical on the estate planning and tax enhancement side.
Yeah. Yeah, no, I definitely hear you. I mean, even me, like, I like to think that I'm more proactive than most. I have a will that's already been created, right? It's outlined. But like, exactly like you said, like if I just died, like, good luck getting into my wallets, you know? Like, I don't think it's gonna be that easy.
My
It's
wife doesn't know where anything is, right? So my best friend is listed in my will, and he knows how to leverage. I have a decent wallet for my crypto,
Yeah.
and she
A lot
wouldn't
of
know what to
quantum,
do with
huh?
it. Yeah. Right, but you understand the value and the point of that, right? You have to have somebody there to pick up the pieces should something happen to you, because life happens every single day. And the best way to think about life happening every day, and I just want to submit this to the group. I know we're talking ETFs. Go read a GoFundMe memorial. You want to make sure you want your ducks in a row? Every single day, somebody at 25, 26, 27, 30, 32, married, not married, we're lost. So do the prudent aspect of wealth planning and creation, and do the paperwork too.
Yeah, I just got a life insurance policy, and without my financial advisor, like I don't know the difference between whole life and term life. I don't know what a term 20 is. I don't know what's a good premium. Having him, being able to go to him and say, "Hey, here's $300 for a few hours. Tell me what I need to know here." And your license, you're a CFP. I have assurance that what advice you're giving me isn't just being generated by ChatGPT. It's the peace of mind that comes with working with a professional is understated. And people out there who still think that a financial advisor is just there charging you 2% of AUM to put you in a couple of active mutual funds, like that model is basically dead now. And as anybody who wants to capture Gen Z inflows later, as Gen Z makes more, as they begin to accumulate wealth and trying to figure out how to maximize and retain much of it, they're going to need someone to work with. And how you treated them when they weren't wealthy is going to make a difference in whether or not they come to your practice.
Yeah. Evan mentioned an advisor I work with. It's going even to the next level for that for me. Now that I have guys in my team that are becoming W-2s, my advisor is setting up the whole 401k plan for the company, right? It's like, there's no way I should be doing that myself.
No, it's such a pain. Yeah, there's just things that I don't want to deal with. I don't want to take the time to learn the education and execute it properly and follow up on it. Somebody else has done that. I'm willing to pay them for their expertise. It's just how the economy works.
That does bring me to one question, which we can hit on, and then we can wrap up at the top of the hour, which is AI. You mentioned, people, just going to ChatGPT for things, and it really is helpful for a lot of things. Like, absolutely, ChatGPT has walked me through so much stuff, and it could be good for research. Maybe something gets built in here on even like ETF Central, right, on the AI side. But I'm just curious how you think of people utilizing AI for ETF research, for investing, for all these different types of things.
You got to be really careful. And I have a great example here. I was actually just reading a piece. I'm not going to say which publication it was, but it was saying that MLPs must distribute 90% of their income to qualify as pass-through. That is actually factually wrong. The actual term is 90% of the income has to come from exploration, production, or transportation of natural resources to maintain its pass-through status. It's not that they have to pay 90% of their earnings out to you. It's that the characterization of 90% of their income must come from natural resources. That is a big distinction when it comes to whether or not you are accurately characterizing the taxation of a master limited partnership. And that was just published everywhere. I remember reading that. I'm like, that sounds a lot like real estate investment trust. And it was. And again, it's just a case of AI hallucinating. So I like using AI. I love it. I like bouncing ideas off it. I like coming up with hypothetical situations that if I asked an industry insider, they probably look at me like I was insane. One of my favorite things to do is to give it a list of ETFs and be like, hey, we're back in 2008 again. The market's blowing up. Which one of these implodes first? And I just like seeing what it does. It might not be factually right, but it gives me a starting point to get the creative juices going. But that's really it. For everything else, look for official sources. See who's backing it, what kind of authority they have, what kind of experience they have, and cross-reference that. The last thing you want to do is be told to do something that an LLM has dreamt up, because it could really hurt you when it's your money at stake.
Yeah, that's a great point there. I knew we got to wrap up here. We've referenced ETF Central a bunch of times. Evan put it on screen. I recommend people going on. You can make a free account, which is nice because that lets you set up a watch list. I do like the watch list feature a lot because then I can just see all the performance and flows, and I can edit this a ton, which was nice for me. Just a lot of the different ones that I was looking at and just interested in what they were doing. And then I definitely recommend that people go read all the writing that Tony's doing. So you can go in, Tony's got a whole profile on here and a ton of great content every single day, pretty much, that's coming out on here. And if you want his thoughts on different ETFs, this is a great place to start. Evan, anything you want to make sure that we cover on this one before we wrap up?
No, I hope we do another one. I want to talk also more about a lot of some of these new ETFs coming out. There's new ones filed every single day, and clearly there's a lot of wealth of knowledge here. So I'm excited to chat again. But yeah, make sure. I put the link in the chat. Let me go and put some ats too in the chat as well. But I appreciate everyone.
Yeah, we'll make sure that everybody gets in and sees these. I like that idea too. Next one of these that we do, let's make maybe like a list of some of these new ETFs, walk through some of the concepts, see how people are getting creative. Bilal, any other comments on this stream today?
No, I think you guys are having a healthy dialogue of key topics and subjects that should be had. I do think we need to continue to broaden the discussion when it comes to like what's available to investors as we look sort of moving down the investment stack into other parts of the portfolio. Fixed income will be a critical component for people depending upon where they are in their risk profile. I do think, it's a great opportunity, to your point, to start exploring municipals. I do think there's an opportunity also to really look at commodities and other ways to diversify risk in the portfolio. Tony listed a bunch of really talented money managers, but there are just so many, and just having a good pulse on what's going on is really important. So, no, you guys are doing fantastic. Thank you for having us, and we'd love to continue to participate.
Yeah, absolutely. Appreciate everything that you're doing as well. Tony, any other comments for this one?
Nope. You can find my writing on ETF Central. One of my favorite things to do is to compare different ETFs. So if you ever have a request, connect with me on LinkedIn and just ask me, hey, Tony, can you put this head to head? I just use data from the ETF Central screener. You can do it yourselves, but I kind of walk you through how to do it step by step with screenshots, what to look for, how to interpret the facts or the metrics. So happy to take any and all suggestions for that.
Perfect. Thank you so much to everyone who tuned in. We will get another one of these going. There you got the ats in the chat. That's good. Evan dropped Bilal's. Tony's not on X, but you can go and check him out on LinkedIn, Tony Dong. Many more good things to come. Thanks so much. Appreciate your time.
My pleasure. Thanks.